Understandably, you guys have had let me say a good weekend, I suppose, because you had a session for math yesterday, and today we're having a session for tax. So yeah, it's been a busy weekend. Yeah, so welcome to class. So my name is Matodonke Mpecho. I will look after you guys and spend quite a bit of time with you guys when it comes to taxation. Um, yeah, yeah. I hope we'll enjoy our time together. The whole purpose of us being together is to try and ensure that I add value to your lives and try and ensure that you are you are better off as a result of these sessions that we have, and yeah, get you guys over the finish line at the end of the year. That's the purpose of what we're trying to do. Okay, we'll talk about a bit of admin a bit later on, but maybe just a bit of a brief background to myself. So I am, as I said, Matodonke Petra. I've been lecturing now. I tend to forget. I think since around 2013. Yeah, since around 2013. I've been with Endunamu now since I think it's about 2015. I tend to forget. So clearly you can see I'm not good with anniversaries. So you can understand in my life, I tend to get in trouble then when it comes to anniversaries. But yeah, so I think it's been from 2015 with the Endunamo team. We've transformed many lives, and we continue transforming a lot of lives. And yeah, adding value to a whole lot of people. I think what keeps me going doing this. It's the difference that you see in people's lives. In the last 2 weeks, funny enough, in the last 2 weeks, um, the first incidents happened where there's a lady I met with. So somebody had given me um, something that I needed to pass on to another person. So this lady calls me and says, no, I will come pick it up from your house. I'm like, oh, it's fine, not a problem. You can come pick it up from my house because she doesn't stay far from where I stay. So indeed, she calls me and says, no, I'm at your place. Can I? I'm like, no, it's fine, not a problem. So I go to her and I give her whatever she needed. So then I'm looking at her face, and she's beaming and she's smiling. So I'm like, okay. When somebody's looking at you with an expectant face, and that smile, and you're like, okay. This person was that smile, comes with something else. It's not just oh, thank you very much for getting my stuff to me, but it's like, okay. So I'm like, oh, okay, that's interesting. Um, but then I think she quickly picked up that I've got this blank look on my face because, in my mind I'm processing and I'm thinking, oh, why is this one smiling at me like that? Is there something I'm missing? Maybe she was supposed to get the parcel and there was something else I was supposed to bring, or the parcel was supposed to be bigger than what I'm giving her, you know. Um, and then eventually, like after like a minute or so, she says, no, I can see you don't recognize me. I'm like, oh, okay. Um, yeah, no, I don't. For me, it's the first time I'm seeing it. She's like, no, it's fine, not a problem. And she says to me, you lectured me at Endunam. I'm like, whoa, okay, that's interesting. And she was like, no, no, and actually I was writing board course and the second board course. And remember, the second board course, the APC results came out about 2 weeks ago, 3 weeks ago. And she says to me, guess what? I passed. I was like, whoa, okay, this is great. And she's like, no, thank you very much for your help. You really, really, really contributed to my life. And now I'm a qualified CA. Yeah, it's been a long journey. And at this point in time, I don't want to see any book. That's generally what happens when, just after people have passed. They say, no, no, we don't want to see any book in front of me. Let me take a break for like a year, and then I'll come back to it once I've taken the break. And then she jumped back into a car and she left. I was like, wow. And those are the things that we live for, you know. It's the difference that you make in somebody's life, and they get to the point where they've qualified and they've passed their exams and so forth. And they're like, okay, this is what you're doing. This is the whole point of what you're doing. You know, even if I get to meet one person and they give me feedback that, you know what, you've contributed positively to my life, and I've managed to pass and all of that. That's what we do. And then the second incident was yesterday. So I was at the gym in the morning, and so as I parked the car, I've opened my boot, I'm looking for something in the boot, and when I close my boot and I'm walking, this guy says to me, "Hey, Matadon." Oh, okay. And I'm looking at him, I'm like, okay, who's this guy? So again, he picks up my blank look. I need to have a poker face, guys, so that people don't pick up that I've got a blank look when I don't know them. Also, same thing. He says to me, no, you lectured me at Endunamo, you know. Yeah, no, things have gone very well. I've passed and so forth. It's like, well, okay, this is great news, that you've passed and everything has gone very well. So it's those little stories, you know, that keep me going. I've the students that I've met, and we've established good relations with them. You know, they still keep in touch. I still keep in touch with them to check how they're doing. Yeah, and then I suppose it goes beyond just what we do in class. It goes to the point that I'm making about, you know, we have these, with some of the students, you end up having these lifelong friendships, where once in a while you check up on them, how are you doing, and so forth. That's what we do as Endunamo. That's what we try and bring to your lives, to ensure that your lives are transformed. It's not just about us sitting here and having taking you through technical matters, but it's also about just ensuring that, you know, we share nuggets with you over and above what is sitting in a book. And I think that's where, for me, the value add is in having these sessions. The fact that you are sitting here in this session, for me, tells me one thing: you can definitely read, and you can definitely read English. Okay, which means all I could do is just throw slides at you. You've got the legislation, and say, go and study. You can read for yourself. That's not what I am supposed to be here to do with you guys. Okay, what I'm supposed to be here to do with you guys is to take it one step further and say, this is what the text says. One, let's try do a bit of interpretation of the text, but over and above that, take that text and simplify it for you, in order for you to understand what the text is about. So, of course, the things that we tend to learn over years and through experience is that we you get to have a deeper understanding and appreciation of the legislation. And, you know, because you've got a deeper and a more nuanced appreciation of the legislation, then you are able to then how can I put it? You are able to share it with other people and give them context, you know, because the legislation does not have context. All it has, it got, yeah, it's written in the book, but you need context in how you bring everything together and how things link with other things. Okay, so for example, when you're talking gross income, or when you're talking capital gains tax or VAT, how does it all link together? Okay, so I also like doing that and say, okay, how does it link together? Okay, so that's the short intro. Oh, of course, you know, because none of you will all of you will start questioning my credentials if I don't mention this, and think, yeah, this guy doesn't know what he's doing. I am a CA by training. Yes, I specialize in tax, but I am a chartered accountant by training. So I have gone through the journey that you're going through, and I understand what it means to walk your steps. And I think over the years I have appreciated it much more, you know, because I guess when you're a student, you're stuck in what you are doing. Whereas once you're outside of what you're doing and you start talking to other people, you're able to appreciate more, you know, the what it takes what it takes to pass CTA, to pass ITC, to pass APC. Yeah. All right. And in terms of maybe what I do at Endunam, of course, I do CTA. So I'm part of the lecturing team for CTA. So I'm the person then that runs ITC for tax. So all the ITC board course. So I run that for tax, and I'm also involved, of course, with the EPC as the specialist that comes in into tax. Okay, my life is slightly easier than yours, guys, because I can comfortably say I am a tax specialist and my life revolves around tax. Whereas unfortunately, your lives cannot just revolve around tax, but you've got the other disciplines that you need to deal with. Having said that, you effectively need to become a specialist on all 4 disciplines. And that's why, you need this very deep understanding of the people that lecture you as specialists, because what we are trying to do is to try and ensure that you also have that deep understanding in terms of the different subject matters that we lecture. Okay, I've been talking and talking and talking. Maybe just a question, or it could one person please confirm for me that you can hear me. There's no break in the connection or anything like that. And okay, cool. Thank you very much, Hope, for that confirmation. Okay, let's then look at no, how can I forget that? Let's take 5 minutes. And in my 5 minutes, what I would like us to do is, you guys woke up very early on a Sunday. Some people around this time, they're still sleeping on a Sunday. But you took the time, you woke up very early because you wanted to come and listen to me. But of course, in you coming to listen to me, I always say you didn't just wake up. You've been thinking about it, and at some point you're like, oh, okay, fine, let me drag myself out of bed so that I can go and listen to this guy. And with that, of course, comes the fact that there's something that you are expecting. There is some outcome that you're expecting from this. So I would like to then ask you guys in the next 5 minutes, let's talk a little bit about what are your expectations, okay, of today's session. So what are your expectations of today, the whole year, in terms of the workshops, in terms of the course, and so forth? So what are your expectations? So I need to note that down. And of course, in us delivering this material and having discussions with you guys, it needs to be aligned to the expectations that you've got. Because I've prepped what I need to prep based on my own thinking. But of course, I could never, I could never get into your brains to get everything. So hence, I always open up this opportunity to say, okay, fine, let's talk a little bit about expectations, and then we'll proceed from there. Okay, the floor is yours, guys. So if you'd like to say something, please do raise your hand, and you'll then get an opportunity to speak. You guys were not expecting me to be the one doing all the talking. Thanks, Khathatso. Please go for it. Khathatso.
Oh yeah, sorry about that. So I think my problem is with exam technique, especially when doing VET, because VET is heavy loaded. So I think exam technique on how to tackle VET. So I think
Okay.
that's my issue.
So you're saying exam technique, specifically VET.
Yeah, VET is so long standard
It
legislation.
simply becomes overwhelming.
Yeah.
Okay.
Yeah.
All right. No, that's fine. Thanks for that, Kutato. I'll definitely talk about that. So the first thing I'm going to talk about, even before we get into the content, I'd like us to spend a bit of time talking about exam technique and how different things come together. Thanks for that contribution, Khutazo. Anybody else? You know, I'm not only getting the awkward radio silence, you know, it feels like I'm getting an awkward TV silence, you know, when you are there's silence and you're on camera and you are waiting, nothing is happening. You know, when a newsreader things go wrong and they're just sitting on the screen and they can't do anything. I feel like that right now. Okay, thanks for rescuing me, Penelope. Please go ahead.
Hello.
Hi.
I think it would be guidance on how to study the legislation, because if the English isn't making sense, and also how to study text as an integrated with the other disciplines, not isolated.
Okay.
Yeah.
Thank you for that, Penelope. So two things: reading the legislation, and then I think I'll write integration with other topics.
Yes.
Or with other disciplines. Yeah, thanks for that, Penelope. I saw something on the chat saying CGT. What do you mean CGT? I saw something on the chat that just said CGT. Tubedile, I see you saying CGT. What about CGT? Okay, Tubedile has disappeared. I'm hoping legislation interpretation. Okay, cool. Which talks to the point of what Penelope was saying. All right. I see Bernie. Let me see. I think it's Bernice whose hand is up. You can go ahead, Bernice. Bernice, you can go ahead.
Oh, okay. I think
You are saying something. I can hardly hear you, hey? It's making a funny sound, but it's not. There's no. It's not translating into something I can hear.
Can you
Still
hear
not
me
hearing
now?
you. Yes, now I can hear you.
Okay, perfect. Good morning, first of all.
Morning.
I can see each and every topic like VAT and the income tax. Like I can see the calculations, but my problem is that when we have to do the implication, but transferring the theoretical part into application form, that is my problem. I can get the calculation right, but not the application in words.
Okay. So you, in a nutshell, you're saying discussion questions is a challenge.
Yes, discussion questions.
Okay. Okay. Thank you for that, Bernice. Righty. Any other hands? Amogelang?
Good morning. I don't know what is asked, but I'm thinking it's like the problems that we find challenging because I just got it now.
Yeah,
Not
so
sure
it's
the question.
what are your expectations? What made you wake up this morning and you're like, this is what I want to get out of the session?
Okay. Now it's like literally specifically to
You Amogelang, you're breaking.
is it better now? Can you hear me?
Amogelang? No, you're
Hello?
breaking. Okay, let's try again. Let's try again.
Oh, okay. it's with specific to a gross income question as well as capital in nature question. Like it's a specific one.
Okay, it's fine. You can at some point during the course of the day. What I would say is, you can ask that question when you're looking at gross income,
Okay.
and then we'll then talk about it in more detail.
Okay, no problem. Thank you.
All right. Thanks, Mkhalang. Okay, anybody else going once? Okay, go ahead, Samuel.
Good morning.
Morning, sir.
Yeah, yes. On my side, I want to maybe to know the integration between the VAT Act and the Income Tax Act, because I saw that some of the stuff that are on VAT Act actually affect the Income Tax Act as well.
Aha. Okay. Okay. So integration within tax and how something like that interacts with the Income Tax Act.
Yes.
Right. Cool. Thank you for that, Samuel. Right, going once, going twice, and no other hand, no comment. Okay, gone. Right, cool. Thanks for sharing these, guys. It does help quite a bit to have more context, of course, in terms of what your expectations are from this session, and to ensure that I address those things as well. Okay, so what I would like to do is, because the okay, I'm trying to think how okay. I think I'm going to start off with looking at VAT first. Okay, let me share my screen. Sorry, let me share my screen before I say looking at VAT. Okay, right. So please note, because I am sharing my screen, if you do put your hand up, I might not see it. So if you do have a question, I would advise that you unmute yourself and just try and get my attention, and then we can then have a discussion. Okay, just a bit of admin, of course, before we start. So, of course, this is phase one that we're looking at. This is the team that works on tax across the board. So you've got Ferdy, you've got myself, and you've got Sidibeng. Yeah, so that's the team, and I think there's one more person that's missing from here. It's Katleho. So that's the lecturing team that works on tax. In terms of the syllabus that we'll be looking at, of course, Income Tax Act, the VAT Act, and then the last two, Estate Duty, as well as the Securities Tax Act. Note at the bottom, it's to a limited extent that you're going to be looking at securities tax and transfer duty tax. There are very specific things that you'd need to know from the Transfer Duty Act, and securities transfers tax is a very small act. I think it's about 2 pages. Okay, 4 pages, and I'm thinking of something printed back to back. Okay, so it's about 4 pages. Not long, not a complex piece of act. So yeah, but very limited, and I know that yeah, some people tend to think, oh, they worry about it, but it's not that difficult. Right, in terms of, though, of course, you're going to spend quite a bit of time throughout the year looking at the Income Tax Act. Yes, there is an extensive bit of work that you need to do relating to VAT, but ultimately the syllabus tends to focus mainly on the Income Tax Act and the types of income that you receive, the deductions that you qualify for, and the different taxes that you pay. So if you look there, the Income Tax Act, so you've got the normal tax, including CGT, donations tax, dividends tax, and then interest and royalties, withholding taxes. Now, something that you need to note, and it's a nice thing. This is our first session that we're having, and I'm raising this already at the beginning when you're looking at this slide, as an examiner, there are certain things I can ask you. And now I'm going to go into interpretation of the required. Okay, so in a question, you will have a required, and you will then, of course, be expected to understand what that required is asking you to do. What do I mean by that? I'll make a simple example. The question can say to you, discuss or calculate the value-added tax implications. Yeah, so can you see this question is being very specific. It's saying the value-added tax implications, which means you are going to look at the implications in terms of the VAT Act. Okay, because it's saying to you, discuss the implications of the transaction from a VAT perspective. If the question then says to you, discuss the estate duty implications, then it means you need to discuss in line with the Estate Duty Act. So again, the required is being very specific. It's saying to you, Estate Duty Act. Let's then look at the Income Tax Act. Under the Income Tax Act, you will find a required saying to you, discuss the normal tax implications. So now what then constitutes normal? Normal tax implications would be gross income, CGT, general, no, not general, but deductions, exemptions, and so forth. Okay, so that would then be your normal tax implications. Whereas the legislation can say discuss the donations tax implications, or discuss the dividends tax implications, or it could say discuss the interest or the royalties tax implications. So again, being very specific in terms of what part of the legislation it wants you to focus on. So when it's saying donations tax or dividends tax, interest and royalties, or it's saying normal tax. Now, the legislation can then, so not the legislation, the required can also then say to you, discuss the income tax implications. Okay, so discuss the income tax implications. So what does that mean? It means you're going to discuss normal tax, you are going to discuss donations tax, you are going to discuss dividends tax. If there's any interest or any royalties that are paid, you will have to talk about that as well. Okay, so something that you need to be cognizant of when you are reading your required, because that required then gives you guidance in terms of what exactly you need to focus on. Okay, but I think what tends to catch out a lot of people is when they get a question that says discuss the income tax implications. Okay, because we're saying income tax, you have to be looking at everything that is under the Income Tax Act. You can have a question that then says discuss the tax implications. So can you see there, that is a very wide required, because it's saying discuss the tax implications. Now, in discussing the tax implications, that means you need to discuss the Income Tax Act, anything that, I mean, you need to discuss the VAT Act, you need to discuss the Estate Duty Act, you need to discuss securities tax, you need to discuss transfer duty. Okay, because the examiner has given you a very wide required by simply saying discuss the tax implications. So it's any tax under the sun that is examinable that you'll have to discuss. Of course, what drives that? So what would drive that, of course, is the information that is given to you in the scenario. So it's not necessarily that you're simply just going to go and discuss what the first thing that comes to your mind. You will say, okay, fine, the required is saying discuss the tax implications, but now what information have I been given? Maybe the scenario does not have any information about dividends. Okay, then therefore there's no need for you to discuss any dividends tax, unless of course there is probably a deemed dividend that arises from that scenario. Okay, or maybe there is a deemed donation that arises from that scenario, which then requires that you then discuss the donations tax implications as well. However, In an instance where there's no deemed donation, there's no actual donation that was made, then there's no need for you to discuss donations tax. Okay, so what would then drive what you are discussing, you need to remember, is one, the information that is given to you in the scenario. Number two, it is what the required is asking you to do. Okay, so that's something that we always need to be cognizant of. What does the required say? What is contained in the scenario? Because that is what drives what you need to do. Okay, and then over and above that, what then drives the extent of what you need to do? You would then also need to consider the mark allocation. Okay, so the extent of what you need to do is also influenced by the mark allocation. So if there is a question for 5 marks, there is definitely no expectation that you will be required to write 2 pages for 5 marks. Okay. There, it's really about, okay, what is the contentious issue? Address the contentious issue, come to a conclusion, because it's really only 5 marks. Whereas if you get, let's say, a discussion question for 15 marks, then you're definitely not going to just identify the contentious issue and then that's it. Okay, you then have to go into detailed writing, detailed calculations in order for you to ensure that you have adequately covered what needs to be covered. Okay, question. Let me pause there for a second and allow any questions if there are any. Okay, I'll take the silence as no questions then. All right, let's then take it further. And so all I've just explained really is now what is then contained in the slides that follow. In terms of what is normal tax, as I said, who administers, of course, this normal tax. So that would be SARS that administers that tax. Okay, so all taxpayers would then have to pay that amount on their earnings that they generate. And of course, this is what then ultimately you will disclose, let's say as a business, is what ultimately you disclose in your books as whether there's an amount that is receivable from SARS or whether there's an amount that is payable from SARS. Okay, now how do you get to that point? So the first thing you will do, of course, in a year, you will calculate what is your normal tax liability. So you'll take all of your earnings, you then say, okay, fine, what deductions do I qualify for against those earnings? And then you then calculate what is then my normal tax liability. Okay. And remember that whether you are a natural person or you are a, let's say, a company or a trust, you will calculate your normal tax liability. And of course, looking at the provisions in the legislation that are relevant to the type of taxpayer that you are dealing with. Okay, so that's also something else that we need to think about. Okay, the type of taxpayer that you're dealing with and what parts of the legislation are then applicable to that type of taxpayer. So that is what will then get your your normal tax liability. Now again, depending on the type of taxpayer, remember that all of us, if you are a taxpayer, all taxpayers have to prepay their taxes. So all taxpayers have to prepay their taxes. What do I mean by that? There is no taxpayer that earns income throughout the year and only pays tax at the end of the year. There is no taxpayer that does that. Okay, the reason why that is the case, it's because, of course, our taxes do fund government, and because our taxes do fund government, government requires a regular flow of income in order for it to do its job. Okay, so they require a regular flow of income in order for them to do their job. So hence, all of us, I'm going to say, have to prepay our taxes. So hence we don't wait until the end of the year of assessment and then say, okay, calculate what is my tax liability, and then only then do we pay taxes. But of course, if that was the case, it would be a nightmare collecting taxes, because what would happen is I would get to the end of the year and decide, you know what, I'm just not going to pay because I don't have the money. I spent the money. I had these challenges that I had, and therefore I've spent the money, and I don't have the money to pay it over to SARS. Okay, so it's things like that yeah, that were considered, and then saying everybody needs to prepay their taxes. So now, how do we then prepay our taxes? So if you are employed, you would prepay your taxes via the employee's tax. So pay as you earn. So you've probably heard of a term saying pay as you earn. So you'll prepay your taxes via pay as you earn. Okay. And pay as you earn, of course, is paid on any amount of remuneration. Later on in the year, you know, that's something that we do focus on when we're looking at individuals and talking employees tax. So PAYE, an amount paid on remuneration. However, if you are not employed, okay, or you're not a person that receives remuneration, then you are then required to register as a provisional taxpayer. Okay, and twice a year, you then have to pay your provisional tax. So if I'm looking at the 2024 financial year as a natural person, what would have happened is that I would have paid my first provisional tax on the 31st of August 2023, and my second provisional tax I would have paid on the 29th of Feb 2024. That is for the 2024 year of assessment that we're dealing with. So as you can see, you pay in the middle of the year, which was 31 August 2023, and then your payment, your second payment, you then make at the end of that year of assessment, which is then on the 29th of Feb 2024, and therefore for that full year you've now paid your taxes. Okay, but remember, when it comes to provisional tax, you estimate what your taxes will be, and you pay according to that estimate. But of course, there are guiding rules or guiding principles around how you must calculate your provisional tax in order to ensure that you have paid as much as possible of your normal tax liability. Okay, then if there's any interest or any penalties, of course, you'll include that and then come to a balance that you then disclose as part of your financial records. Be it's an amount that is payable to you from the tax authorities, or it's an amount that you need to pay to the tax authorities. Yep, just a bit of background. And then in terms of the rates that are applicable to different taxpayers. Okay, so if you're a company or closed corporation, of course, we'll apply a rate of 27%, except if you are a small business corporation, because remember, for a small business corporation, it's a sliding scale, even though, yes, the highest rate for an SBC is 27%, but it's on a sliding scale depending on the taxable income of the SBC. Yeah, okay, if you're an individual, okay, it's a sliding scale, 18% to 45%. Whereas if you are a trust, a normal trust, or an ordinary trust, then it's a fixed rate of 45%. Whereas with a special trust, it is taxed in a similar manner to how individuals are taxed. So then it will be a sliding scale again, starting from 18% to 45%. Okay. Okay, quickly just go over this. So in terms of calculation of taxable of your normal tax liability, you will see that, of course, you start off with gross income, and I think this table is quite important, guys. And why do I say this table is quite important? Because there are a number of things that are contained in here that should give you an idea of what is the level of integration that you need to have. So as an example, as you can see, when you're doing a calculation of taxable income, there is quite a lot that you need to know. What do I mean by that? As you can see, there's gross income section 1 definition. But of course, within gross income, there's the definition, but there's special inclusions in there. So yes, it might look like it's only one line here, but there are a whole lot of things that then fall under the gross income definition and the specific inclusions under gross income that must be dealt with and understood. You then have exemptions in terms of section 10. Okay, so again, if you know these things, for example, if you're looking gross income, you know that it's section 1. If you're looking at exemption, you know that it's section 10. What this does is to aid you in your thinking, in that whenever you've got income and you want to find out, does this income actually qualify for an exemption? You know that section 10 is your section where you need to go and look for exemptions. So this is just a high-level picture of the legislation, so that you are then able to identify what are the different areas where you can find things. Okay, so when it comes to exemptions, you need to go to section 10 and look there. Okay, you then get to income. Now, please note, income is a defined term. And what do I mean by defined term? When you're looking at section 1 of the Income Tax Act, it defines for us what is income. So whenever you come across a question or whatever it is that talks about income, it's talking about income as defined. It's not saying gross income. It's talking about income as defined. So when something says to you in the legislation, this amount must be included as part of the income of the taxpayer, it means you will include that amount below this income definition. So anything that goes under there. So for example, if you look at something like taxable capital gain, Section 26 Cap A says that a taxable capital gain will be included as part of the income of the taxpayer. Okay, so that's what informs then the layout of this table, because we are talking about income of the taxpayer, not gross income, but income of the taxpayer. Or an amount of a deduction can be claimed against the income of a taxpayer. So that is why when you're looking at a general deduction formula, it talks about you're allowed to get a deduction if that expenditure is incurred in the production of income. So when that production of income that they're talking about income as defined. So that is why if you got an amount that is included as part of gross income, and then there's then an exemption that is applied against that amount, then that does not constitute income because that amount is exempt. And that is why when you are then looking at the deduction, there's even a prohibition against the deduction of an expenditure that is not incurred in the production of income, or that is incurred in the production of non-taxable gross income. Okay, so that's why section, if you look at your prohibitions, and I'm trying to think top of my head, it's section 23. It's not D, is it Q, if I remember correctly? Okay, I think it's section 23. Oof, I think it's section 23Q. That then says, it's okay, no, anyway, but I know it's under 23. That then says,
is it not section 23G, the one that we read together with section 11A?
23G read together with because 23G does not talk to the trade requirement, but yeah, I think 23G talks to the trade requirement. But again, that is something that is definitely relevant when you're looking at it with the deductions under section 11. Yeah, thanks for that. I think it's Andani that was talking. Thanks for that, Andani. Okay, so we're talking income as defined, so it's always important that you remember that that's something that is defined. Okay, then of course looking at allowances that are received, as well as what if you've got any assessed losses that you can then claim against the income. Of course, something that you would have seen in recent changes in the legislation with regards to assessed losses is the extent to which you can utilize assessed losses. So what do I mean by that? The extent to which you can utilize assessed losses. If you look at section 20 Cap A, it says, so in the past, what would happen is that if you have an assessed loss, you could apply that assessed loss. Remember, an assessed loss is from a previous year. So let's say in 2023, you made a tax loss, it gets assessed by SARS, and therefore you've got an assessed loss. So that assessed loss, in 2024, let's say you've got taxable income in 2024, that assessed loss could be utilized against the taxable income in 2024. Okay, and there were no limits. But what has been introduced is that when you have an assessed loss, you can only utilize that assessed loss to an extent of 80% of the taxable income in that year. So what does that mean? It means, it means, let's say let's use these numbers. So let's say so you've got taxable income 2024. Okay, and that taxable income in 2024, let's say it is 35 million. Okay, so we've got a taxable income in 2024 of 35 million. And from 2023, we've got an assessed loss from 2023. Let's say this assessed loss is an amount of, let's say 45 million. Okay, so you've got an assessed loss of 45 million from the previous year of assessment, and then you've got taxable income of 35 million in the current year. What the legislation says is that this assessed loss is more than this. So which means if you're to apply this assessed loss in 2024, you're going to end up not paying any tax. But what the legislation has now said with the recent amendment is that you can only utilize the assessed loss to the extent of 80% of the taxable income. So we first then say, what is 80% of taxable income?
80% the taxable income.
Okay, so 80% of taxable income would be 80% of this 35. So that means 28 million. So then when we then calculate the taxable income for 2024 after assessed loss, okay, we're going to end up with the 35 minus the 28. So ultimately, even if you've got, let's say this is a company, so we'll then apply the company rate of 27%. Okay, which means there will be tax paid in this year of 1.8 million. So what this change in the legislation has done is to effectively say, even if you are making losses in a year where you've made taxable income, there is a minimum amount of tax that you need to pay. And then what will then happen is that a portion of the assessed loss that you've not utilized, you will then carry that forward into the following year of assessment, okay, which means after this, we're then going to have a carried forward assessed loss. And that carried forward assessed loss will then be the 45 minus what we utilized in the current year, which is the 28. So we still have a 17 million assessed loss that we are going to carry forward. Okay, and if we do a bit of integration with accounting, it's an assessed loss, and therefore we would then recognize a deferred tax asset on that amount, because of course that assessed loss will result in future benefits flowing to the company when it gets utilized. Okay, so then that would then result in a deferred tax asset being recognized. Okay, but over and above that, in you recognizing the deferred tax asset, you need to think about will the amount be recoverable? Okay, so when you're thinking about your impairment standard, okay, you are then saying, okay, fine, I've got the 17 million sitting there, but is the amount recoverable? So is there a prospect?
Can you please repeat the company rate?
The company rate is 27%.
27% of
the taxable income
after assessed loss.
That is correct.
Oh, okay.
Okay, right. So as I was saying, so that deferred tax, you'd have to prove its recoverability in order for you to recognize it as part of your books.
Sorry, just to ask, will we discuss in section 20 of the income tax?
Yes, well.
Okay.
Yeah. So it's section 20. So when you're looking at assessed losses, you're looking at section 20 of the Income Tax Act.
Because I'm failing to find the percentage, the 80% percentage. I don't know if on the legislation.
So that should be sitting in, so that I can direct you.
Oh, on the gray area. Yeah, because I'm seeing it here.
Yeah, because remember that's a recent amendment. So if you're looking at section 20, subsection 1A, Roman numeral 2.
Section 20, subsection A.
No,
Roman,
section 20, subsection 1.
Subsection 1.
So 20, subsection 1A, Roman numeral 2.
Okay, I think it's because of the legislation are different.
Okay.
Okay, thank you.
Thank you. Which year legislation are you looking at?
2022.
2022.
Yes.
Okay. Yes. So this is a recent amendment. So hence I'm spending a bit of time on it just to highlight it for you guys. Because you know what tends to happen. You get recent amendments and examiners want to examine recent amendments. So something to be on the lookout for.
Thank you.
Thank you.
Sir?
Yeah, please go for it.
May you please explain the carried for, what do we call the carried forward asset loss? I think I got lost how you got to the 17 million.
Okay. So our starting point was that in 2024 we've got 35 million as taxable income. That 35 million is before taking into consideration the assessed loss. And the assessed loss that we've carried forward from 2023 is an amount of 45 million. However, remember, Section 20 limits the extent to which we can utilize that 45 million. It says that we can only utilize this up to 80% of the taxable income. So what is then 80% of the taxable income in the current year? So it's 80% of this 35 million, which gives us an amount of 28 million. That means of this assessed loss, we can only utilize 28. So then that means if you take 45 minus the 28, you are then left with 17. So the 17 is what we carry forward into the following year of assessment.
So you took it's actually the 20% of the taxable income.
No, it's not
No,
20%
it's not.
of the taxable income.
Wait, please repeat that. I'm sorry.
Okay. I'll even try and see if I can make an illustration for you, because 20% of the taxable income is 7 million, not 17 million. Can you see that?
Yes, I see that.
Okay. So that then takes it away. It can't be 20% of the taxable income, because 20% of 35 million is 7 million. What this is to say we have an assessed loss of 45 million. How much of that did we use? We used 28 million of the 45. What is then left after using 28 from the 45? We are then left with 17.
Oh, now I see it. Thank you very much.
So the 17 is what then we'll carry forward into the following year of assessment. And then in the following year of assessment, we'll then try and utilize that 17 against the taxable income in that year.
Okay. Thank you very much.
Pleasure, ma'am.
Just one last question.
No problem.
Since the legislation, the section is saying any person is not specific as to like a natural person or a legal person. So
yes, it's any person.
Any person, yes.
Yeah.
So when we are doing this, the difference will only be on the rate, right? So the 27% will obviously apply because it's a company's rate. But then in terms of an individual person, let's say it's all proprietor that will be carrying on the trade. Be doing, but then the effect of the rate will be seen in the tax table.
100%.
Using the sliding scale.
100%.
Okay.
So remember, in order for you to get to your taxable income, it depends on that you, of course, you don't make a distinction of whether you are dealing with a natural person or you're dealing with a company. Ultimately, it's the same manner in which you'll get to a taxable income. The difference would only come in once you start calculating the tax. So in our example, we chose a company, so we then used a company rate. Whereas if this was a natural person, then you'll then say, what is the tax table or what is the band in the tax table that is then applicable to a natural person that has got taxable income of 7 million.
Okay, thank you so
Okay,
much.
thanks. And if it was a trust and it's an ordinary trust, then you'll then apply a flat rate of 45% to that 7 million.
Yes, thank you.
Okay, thanks, Amo. Right, any other questions before we move on from here? Okay, thank you. Come back to this side. Okay, right. So let's jump on to gross income and looking at the general definition. So when we're looking at gross income, so remember anything, so all taxpayers pay their taxes, and as we're looking at this table, remember everything, the genesis of everything that we're doing really starts off with gross income. Now, what I always say is that when you are looking at a question and you don't understand, so let's say you're reading the scenario and you're saying to yourself, I've got absolutely no idea what is happening here in this scenario that has been given to me. I always say you need to take a step back and go back to basics. And what does it mean, go back to basics? For me, it's always a matter of saying, okay, is there an inflow or is there an outflow? Okay, so if there is something that is flowing towards the taxpayer, then for me, I always start off with, okay, fine, let's consider gross income. Whereas if there's an outflow, meaning there's something that's flowing away from the taxpayer, then for me, I always say we need to consider section 11. So in a transaction, taxpayer received 10,000 rands. That's an inflow for the taxpayer. Therefore, my starting point would always be gross income. Whereas if a question says a taxpayer paid 10,000 rands, then for me, that's an outflow, and therefore my starting point is then section 11 and looking at section 11A and so forth. Okay, let's then have a look at gross income. Gross income is quite an important definition, of course, that we all need to have a good appreciation thereof. Okay, the reason why we need to have a good appreciation thereof, because we need to assess whenever we receive or something accrues that thing must be included as part of a taxpayer's gross income. Okay, so just as a quick recap, because this is something that you guys know. So when you're looking at gross income, so in relation to any year of assessment, so again, remember tax is a yearly event. Yeah, so tax is a yearly event. So whenever you are considering a transaction, you must consider that transaction within a particular year of assessment. Okay, I know we are accountants. Then what tends to happen with accountants, with accounting, is that there's certain transactions that you can correct in a following year, in a following financial year. Whereas, or let's say you're looking at the balance sheet, as long as your balance sheet is reflecting the position of a company at a particular point, that tends to be fine. Whereas when it comes to tax, tax is looking at a specific year of assessment whenever you're assessing transactions. And therefore, when you are trying to fix something, you have to fix or you have to account for whatever you accounted for in the year that it happened. Okay, so for tax, timing of a transaction becomes very important. So that's why even in the gross income definition, the first thing it starts off with is in relation to any year of assessment. That talks to timing of the transaction. Okay, it's always important that you assess the timing of a transaction. So it means in the case of any resident, the total amount in cash or otherwise received or accrued to or in favor of such a resident. Remember, first things first, we're looking at a resident. Now remember, residents for us are taxed on their worldwide income. Okay, so we need to then certify what's this amount that this resident has received. And of course, there is case law that then accompanies what is total, well, starting off with who is considered to be a resident. Okay, so there is case law that deals with that. Okay, if you look at the Cohen case and the Kirtle case, those two cases deal with determining whether a person is a resident or not. Okay, we then go and look at the total amount, what then constitutes total amount. Okay, and again, there's case law that gives us guidance in terms of how do we then determine what is a total amount. Okay, and that amount, of course, does not have to be in cash. Okay, it's always easier when an amount is in cash because it's easier to identify, it's easier to place a value thereon. However, you can receive other things that are not cash, and those things will still constitute an amount that has been received or that accrued. And in an instance of a person that is not a resident, so for in the instance of a person that is not a resident, you'll of course only consider amounts that are received that are deemed to be from a source within the Republic. Okay, again, there is case law that deals with how do we determine source. Okay, one of the leading cases on that for your purposes, guys, is the Lever Brothers case. Okay, which then says where is the source of that income located. So if the source of that if the source of a certain income is located in South Africa, then that means that that income is from the Republic. So simple example would be, as a non-resident, I own a property in South Africa that I am leasing, and therefore I am generating rental income from leasing the property. So the first question is, what is the source of that rental income? The source of that rental income would be the property situated in South Africa. And because the source of that income is the property situated in South Africa, then that rental income is then deemed to be from a source within the Republic. Okay, there are, of course, specific transactions that are dealt with under Section 9, subsection 2, that are specifically identified as income or transactions whose source is the Republic. So if we look at something like Section 9(2)(a), which then says that if you receive interest, and that interest is paid to you by a resident of South Africa, then that interest is from a source within the Republic, and therefore it must be taxed in South Africa in terms of the Income Tax Act. Or if you receive a dividend that is paid by a South African company, then that dividend is deemed to be from a source within the Republic. And because it is deemed to be from a source within the Republic, you are then required to pay taxes on that amount in the Republic. Okay. So I hope the other thing you've noted in us having this discussion is how I am integrating with other things. I'm talking gross income definition, but what I'm also doing at the same time is integrating case law. I've brought case law into this discussion, and at the same time, I'm integrating with other parts of the legislation. So I've spoken about Section 9 of the legislation and saying, how is Section 9 relevant to what we are doing over here when we are looking at gross income and looking at the source of the income. So it's always important that when you're looking at a question, you don't just limit yourself to say gross income, but think of the other things within the legislation that you'll then say, okay, fine, how is that relevant and how does it link to the question that I've been asked and linking back to gross income? Okay, so that's the integrated thinking that we need to have, okay, because we need to draw from different parts of the legislation in dealing with a question. Okay, we'll talk more about that, of course, when we are looking at the tutorial later on today, but that's something that we need to be cognizant of. How do we draw from the other sources when we are looking at a particular set of information that we must interpret? Okay, and I think the other important thing here that I want to talk about is, of course, it says excluding receipts or accruals of a capital nature, right? Because we do have capital gains tax regime in South Africa. That's why you then exclude anything that is capital in nature, because anything that is capital in nature will then be subjected to capital gains tax. Okay.
Can I ask?
Go for it.
Yes, I think the question that I had earlier about the difference between like gross income and capital nature would come here. So if you are required to do gross income, whether something constitute a gross income or should be included in the gross income level of someone, we would do like that theory of explaining like each step, total amount, and doing the cases, like your lateja and your pucha plus all those cases, cash or otherwise, and finish finish the part and conclude that okay, it's gross income. And then you also do a part where you have to discuss whether it's capital in nature, where you bring other different cases like your starts, all those cases. So like when you are asked to do such question, how do you then know that I should actually come bring cases of gross income rather than bring capital in nature questions? Because I've been asked a question, or I've done a question where they ask if it constitutes gross income, but then they only added on a line to say that, okay, this amount was received by whoever in this current year of assessment, therefore it will be included in gross income. But they went on to discuss capital in nature cases and not necessarily gross income. So how do you know that, okay, I need to discuss this and not that?
Okay. What was the mark allocation there?
It was around about 13 marks.
13, 1-3.
Yes. Yes.
Sheesh, okay. Right. So again, I don't have the question in front of me, so my response will be very generic because I'm unable to specifically talk to that question. But what I would say for a 13-mark question, for me, you would have to look at the gross income definition and discuss the different elements of the gross income definition. That's the first thing I would say for a 13-marker. Over and above that, you would still be required to discuss whether something is of a capital nature, so that receipt or accrual, whether it's of a capital nature. Okay. The other thing to consider, of course, is what was there in the scenario, because the things that you must tend to be on the lookout for is that there's certain information in a scenario that is what can I call it? That is obvious. That, you know, the question would probably say person A is a resident of the Republic. So then there's no need for you to discuss residency. Okay, all you want to say is that because taxpayer X is a resident of the Republic, they are taxed on their worldwide income. That's where you leave it. Okay, so there it's very obvious information that is provided to you. It therefore takes out the discussion around residency. But what you then need to be on the lookout for is what I'm going to refer to as the gray area. What do I mean by the gray area? The gray area is the information that is not 100% clear from the scenario that is given to you. And that's where you then need to spend a lot of time having your discussion. So you might find that from the question, it's very clear that an amount was received, and that amount was received for services rendered. Okay, so there's no discussion around is it revenue or is it capital in nature. Okay, you've rendered a service, and therefore that amount must be included as part of the gross income definition. And then we're not going to spend a lot of time discussing whether it's revenue or capital in nature, but you're simply going to look at the gross income definition and conclude on that. So you'll then discuss the different elements of that. Okay, I don't know if that answers your question, Amkhana.
Yes, perfect. It does.
Okay,
It does.
thank you.
Thank you.
Okay, right. So remember I spoke about, there are elements of the gross income definition that you need to look at. So things like what constitutes a total amount. Okay, I think what's important here is, of course, an amount does not, as we said in the gross income definition, it can be in cash or otherwise. But what's important is that in us saying there is an amount, there needs to be something with a value. And as you can see, I'm using the word something. Okay, so there has to be something. So there has to be some sort of asset or property or anything. So there has to be something. And that something needs to have a value. So we need to be able to determine what is the value of that thing. And because you've determined what is the value of that thing, you then have an amount. But of course, the other additional thing, as you can see in the PEP store case, is that the right to that amount needs to be enforceable. Okay, so we don't just consider Lategan, but we need to consider Lategan in conjunction with, for example, Butcher Brothers, as well as the PEP stores. Again, driven by what is contained in the scenario. Because some scenarios, you'd only need to apply Lategan and not think about Butcher Brothers, think about People Stores. Whereas in some scenarios that are given to you, you'd have to consider all three of them. Okay, so in cash or otherwise, Plumeria, as a recent case, is one that I think it sort of gave a recent flavor to this concept of an amount is received in cash or otherwise. Okay, and but mainly focusing on otherwise, because cash is very easy. If I give you 100 rands, 100 rands, 100 rands. Whereas where we're saying it's otherwise, then we then need to look and say what benefit accrues as a result of the transaction. Okay, and that was the case with the Plumeria, court case, where they looked at it and said there is value that is being exchanged in this transaction, even though it's not cash. Okay, so on the one hand, there's interest-free loans. Okay, but on the other hand, as a result of those interest-free loans, you then get to use a property. Okay, so maybe let me take it one step back and give more color to this case and give more detail. So you've got a property developer. The property developer goes and develops a retirement village. Okay, so property developer develops a retirement village. And then what then the property developer does is to then say, if you want to stay in this retirement village, you need to give me an interest-free loan. So give me an interest-free loan. However, in exchange, I will then give you access to utilize the retirement village. That's what happened in the Plumeria case. Give me an interest-free loan. In exchange, I will give you the right to use the residential unit. Sorry, an interest in the residential unit. Okay, so that was the agreement. Now the court looked at this and said, okay, there is a quid pro quo arrangement here, where one party acted in a certain way in exchange for something else. And because that is the case, something has been received, a benefit has been received. Of course, and that benefit then, they then needed to ascertain what is the monetary value of that benefit that was received, and then they were then taxed on that benefit received. Okay, so very important. It does not have to be cash. You have to look at what benefit, and the important thing, it has to be a quid pro quo arrangement where both parties are benefiting as a result of the transaction that has been entered into. Okay, received or accrued to. Again, the important thing is the entitlement. You know, you need to become entitled to something. But over and above that, in the Moy case, it took it a step further. It said that you must be unconditionally entitled to something. Okay, so in Lategan, they said you must be entitled to it. But in Moy, one step further, must be unconditionally entitled. Okay, and then if you look at the Vets Association of Racing Clubs, there's another case there where an amount needs to be received. Needs to be received for your benefit. Now, what do you mean by it needs to be received for your benefit? In the case of the Vets Association of Racing Clubs, people donated amounts, and those amounts went into the bank account of the club. And the club had access to utilize that amount, even though their initial thinking was that we are going to have a fundraiser, and those funds that we've received as a result of the fundraiser, we're going to give to someone else. Okay, however, that amount went into their bank account, and there was no distinction between the amount donated and the amount that belonged to the clubs. And because there was no distinction, then the legislation then says it is received for your benefit because you could utilize it. So it was not ring-fenced and put somewhere separately, no. They could utilize that amount for their business. And because they could utilize that amount for their business, it was received for their benefit. And that's why they ended up having to pay tax on that amount. Okay. So there are quite a number of other cases that you would have to look at. Okay, I think the one I just want to touch on is just on gift cards. Okay. So we're looking at that and we say, okay, fine. In an instance where there is a gift card that has been received. Okay, so you'll see that the mere segregation of receipts in respect of unredeemed gift cards it doesn't mean you're holding, or it doesn't mean that you are not holding the money for your own benefit. Okay. However, because of the Consumer Protection Act, okay, there is a legal context that is then brought on, because then the taxpayer, as a result of the Consumer Protection Act, is required to take and hold the receipts of the card bearers and to refrain from applying the receipts as if they were its own property. Okay, so you've received the amount, but you're not allowed to utilize it as if it's your own property. Okay. Therefore, even though a taxpayer receives an amount relating to a gift card, it is not received for their own benefit, because the Consumer Protection Act specifies and says that you need to put that money aside until it has been utilized. And when it gets utilized in the gift card, only then do you then say, okay, fine, I have now received an amount. Okay, but before that, the amount is not received, and it should therefore not be included as part of the gross income of the taxpayer. Okay. Yeah, it's more cases. I'm not going to go into the detail. And before we move on from this topic, of course, the other thing then to look at is it says that it excludes any receipts or accruals of a capital nature. Okay, so receipts or accruals of a capital nature, meaning that those will be subject to capital gains tax and should not be included as part of the gross income. Now, what are the things that you need to consider when you're then looking at whether something is of a capital nature? So in the following order, of course, you first need to look at what is the intention of the taxpayer. So when a taxpayer incurred, sorry, not incurred, but when a taxpayer received the amount, what was the intention of that receipt? Yeah, so what was the intention of that receipt? The other thing to then look at is to then look at the objective factors. Okay, that then support the position that the taxpayer wants to hold. So what do I mean by support what the taxpayer position that they want to hold? It's if a taxpayer wants to argue that a receipt is capital in nature, then we have to look at the facts in front of us and say, okay, fine, why is it capital in nature? And look at the objective factors. Maybe your intention was initially to hold something as trading stock, but at a later stage you then changed your intention and you decided to hold it now as a capital investment asset. Therefore, when you dispose of that capital investment asset, you would then take that into consideration that no, now we're no longer disposing of trading stock, but we're disposing of a capital investment asset. Okay, then the last thing then, of course, to look at is the continuity. What do we mean by continuity? It's the extent or the frequency at which you enter into that transaction. So what do I mean by that? I think the easiest illustration is usually around shares. So if I buy, so I've got cash and I decide, okay, I'm going to buy shares with that cash. If I buy those shares and I dispose of them on a frequent basis, meaning that I buy them, hold them, if there's a profit, I then sell, and then again, I go and buy another one, and within a short space of time, I then sell. Then we then look at, okay, what is the frequency of my acquisitions and disposals? And from that, taking into consideration, of course, the intention as well, we then say, okay, fine. Yes, you might have had the intention of being an investor. So I'm using these words very deliberately, of an investor, because remember, an investor is somebody who puts money there so that it can grow on a long-term, with a long-term view. So an investor will not necessarily be buying and selling shares on a regular basis. So their frequency of buying and selling would be at a much lower frequency compared to a share dealer. A share dealer will have a frequency that is quite high in terms of them buying and selling shares. Okay, so a share dealer, for them, the receipts when they dispose of the shares will not be capital in nature, but would be revenue because of the frequency at which they are buying and selling those shares. So effectively for them, it's like trading stock. They buy the shares, they sell the shares within a short space of time. So whenever you are looking at those shares, you are looking at those shares as if those shares are trading stock. Over and above the critical factors that you need to look at, of course, there's also the case law that relates to here, and there are quite a number of cases that you'd have to look at. So it's not just the FISA case, but from the FISA case, you need to look at what is a tree versus the fruit. So the tree and fruit principle. The tree, of course, is what bears the fruit. So that's why when you're looking at the tree, we then look at the tree and say the tree is the capital. And whatever then flows out of that tree is then what we refer to as the fruit. Okay, so whatever flows from that tree is what we refer to as the fruit. Because remember, every tree bears fruit, and that fruit comes on a seasonal basis. So depending on the season, there's always fruit that tree will always bear. However, the tree remains intact. So if I were to translate that into monetary terms, let's say you receive 300,000 in terms of cash, and you take that 300,000 and you put it in a fixed deposit account. That 300,000 remains the 300,000. So when you go to the bank and you say to them, can I have my money? The bank is going to say, okay, you gave us 300,000, here's your 300,000. That 300,000 is the tree. However, if you put that 300,000 in a fixed deposit account, then on a daily basis, interest is going to accrue on that 300,000. So that interest that is accruing on a daily basis on that 300,000 is then what is the fruit, because that interest is as a result of the 300,000. Okay, if I were to use another example, let's look at the example of a cow. So let's say a dairy cow. So a dairy cow produces milk. So then what is the tree? The tree is the actual cow itself, and the fruit is the milk that is produced by the cow. So if you were to sell the cow, you are selling the capital asset, which is the tree. But when you are selling the milk, you are selling the fruits of the capital asset. And therefore, the sale that you're making of the milk is capital in nature, whereas the sale of the cow itself, that is a transaction that is capital in nature. So sale of milk, revenue in nature, sale of cow, capital in nature. Okay, I hope those two examples do make it clear. Yeah, go for it.
May you please re-explain it, because I tend to also, I'm not really clear of the tree of the fruit when, especially when you speak about the cow. Can we put it like, I see the cow part, but if we see, like, can I put it in a property form?
Okay.
Whereby, okay, I purchase a property and then but through other property, I decide to rent it out. And my business is rent, let's say it's obviously rentals and property. So what are you trying to say is that the property is the capital in nature. So if I sell it, that means that means it is in capital in nature. So, but if it's the fruit, which is the rental, that means it's the revenue in nature.
That is correct.
Oh, okay.
That is correct. Because remember, the rental you receive as a result of the property. So the fruit is what emanates from something else. So it's that thing that happens as a result of something. Whereas the tree is what is the thing that gives rise to something else.
Okay. So, but does it matter the type of business in the case study in order to apply this and to know that it's a revenue in nature?
It definitely does. It definitely does. Because, so for example, if I buy and sell property, and that's my business. So I go out and I look for a bargain and I buy the bargain, and I what do they call these people on TV now? And I'm trying to use so if I am a person that flips properties. Okay, so I'm a person that flips properties, which means I go in, I buy a property cheap, I fix it, and then I sell it. So can you see my intention from the word go is not to be an investor. My intention from the word go is to buy a property and then sell it. So that business, the buying and selling of property, when a property is being sold, that property that is being sold is trading stock that is being sold. Okay, so it's trading stock that is being sold, and therefore that property cannot be capital in nature, because the nature of my business is to flip properties. Which is different to an instance where I buy properties. The nature of my business is for me to buy a property, fix it, and rent it out. That's completely different.
So this way it goes back to the critical factors you were talking about: intention, objectives, and continuity. And then I come with the FISA part.
Yes.
Okay.
Okay.
Yes, thank you very much.
Thank you.
Sam, can I ask if you have like a scenario whereby it was a deceased person that is giving out I don't know, like an asset that was held for like in capital in nature and then not donated, it's an inheritance to the next person, right? And then obviously it was capital in nature in the deceased sense. And now it's transferring to the next person. Let's say it's a beneficiary or a daughter. But then now the daughter wants to leave, maybe let's say the country, and wants to sell the asset after it has been distributed to her. So the use or the intention of the daughter, does she inherited from what it was previously used from the previous person or the deceased, since we can't tell how, since like the daughter hasn't really held it for long and we can't really tell the intention, or how do you go on about that?
Okay, so let's start off with a deceased person. So when a person is deceased, and you'll see, we'll talk about it when you get to CGT. So when a person is deceased, they're deemed to have disposed of all of their assets. And because they're deemed to have disposed of all of their assets, and if those assets are held as capital assets, then there'll be capital gains tax implications for the deceased person. Right. Now, that asset then gets transferred to a beneficiary. Okay. Now, when that asset then gets transferred to a beneficiary, we then need to assess the intention of the beneficiary. So it's not like the beneficiary inherits the fact that that asset was held as a capital asset. Okay, we have to look at so we look at the critical factors for the beneficiary and say, are they intending to hold that asset as a capital asset, or are they intending to hold that asset as a revenue asset? Okay, so if they're intending to hold that asset as a revenue asset, does it mean then they're simply going to, as soon as they inherit it, they're going to dispose of it? Okay, or when they got the asset, they did not have any intentions of selling it, and therefore their thinking was that, you know what, I'm just going to rent out this property. And then what then happens along the way, they started thinking about, maybe I would like to leave South Africa, and because I want to leave South Africa, then now I'm thinking of selling the property. Okay, so again, in the example that I have made, for me, the property has remained capital in nature. It's just that a person wants to dispose of that property at a certain point in time. It does not mean that the nature of the property then changes from capital to revenue.
Okay, so if I'm understanding you quite correctly, is like we're looking at the objective factors like you've been saying. So the reason of the daughter selling the property was not really because of there is like getting revenue from it or getting profit from it, but then one just wanted to get rid of the property because of like she's not staying in South Africa or she's living outside the public. So the intention won't change from the previous person or from where she inherited it.
Yes. So yeah. So we'd have to say, what was, after inheriting the property, what was your intention?
Okay.
Yeah. And if I was in that person's shoes, my intention would be very clear. I wanted to hold this asset as a capital asset, because remember, CGT is at a lower rate than I'm going to say than normal tax. Therefore, you obviously want to say my intention is to hold this asset as an investment, and now that I'm selling it, I want to have CGT implications.
Okay, thank you.
Right, thank you. Okay, so we did speak about the intention, so not gonna spend a lot of time on intention, and there's quite a bit of case law around that. And I think the leading case again on intention is the Natal Estate Limited, right? Where they looked and said, what was the intention of the taxpayer when they acquired the asset? But I think what is quite key in the Natal Estate case is, of course, the fact that they crossed the Rubicon. What do we mean by they crossed the Rubicon? So you've got people who have owned land for 45 years. Then they decided, no, they're going to develop properties within that land. Okay. So in them developing properties within that land, the court then held that no. In actual fact, they went beyond. So when you're talking about crossing of the Rubicon, they went beyond what would be regarded as normal in trying to realize the best profit on the sale of that property. So they went beyond when they developed the residential area within their land. And as a result of that, the court held that their intention had changed from holding that land as a capital asset, but now holding it as a revenue asset. And therefore, when they then sold the land, it was not treated as the sale of a capital asset. Okay. Leading case when it comes to intention and ensuring that you do not cross the Rubicon if there's certain things that you're going to do as part of you holding an asset as a capital asset. Okay, right. So I'm going to, but you've got these, so I'm not gonna spend a lot of time on that. Okay, let's do this. According to my watch, it is 9:44. Let's take a bit of a break. Okay, so let's come back at 9:55. Okay, so we do a 10-minute break. Let's come back at 9:55.